Hi guys and welcome to the trading show. This week we are gonna talk about
markets, Bitcoin still weak. Our portfolio, grain market surges. Tip of the week, should I buy the worst stocks? And the weekly rollovers.
and if you are interested in systematic trading, then subscribe to our channel. I am Francesco Placci, Head of R&D at Unger Academy. Let's start from the market overview to see together what happened during the week.
This week we have seen a small decline on all equity indexes, a slightly more pronounced decline in the European indexes. Here we see the Eurostoxx 50, which is in the middle of a small decline started a few weeks ago. Bond indexes continue their recovery with the exception of a small decay on the T-note. We can see the US Treasury futures that earns another 0.5%. The entire energy sector has been rather negative after the uptrend seen in the recent months. Metals are showing mixed returns but lower than 1.5%. A positive week for meat and soft commodities with a small exception regarding feeder cattle and cocoa. The most interesting aspect of this week is related to the strong returns of grains. As you can see, they are very high compared to the trend of the last few months, in particular the wheat, which has set a plus 12% in the last 5 days with a consequent increase in volatility. Slightly negative returns for currencies as well as for Bitcoin, which this week has lost about 5%. The chart of Bitcoin price seems to tend towards a convergence on this support around just over $30,000. Let's now take a look at the implied volatility term structures of the SPX index. This week there was a small rebound on all volatility indexes, but the structure is still in full contango. Everything is quiet and calm if we look at the value of the fear index, so the volatility expected for the next 30 days, and this index remains around medium-low values.
After seeing some key statistics on financial markets and given the fact that automated traders also use this data to build their trading strategies, as usual, we will now take a look at our portfolio of trading strategies to see how systems have reacted to current market conditions.
Hi guys, from Alessandro Danos and welcome to this new appointment with the analysis of our portfolio. This week I want to show you two strategies on grains market, which is composed by wheat, corn, soybeans, soybean oil, and also some other smaller future, less relevant we can say also. And in particular I will show you two strategies, one on the corn futures market and the other one on the soybean market. We can start from the first strategy on the corn future. There is a, we can say, a trend following strategy that enters long when the market break above the high of the current session. We can see a beautiful series of trade. Of course, we have seen also some stop losses, and now we are short with two contracts, and we hope, of course, for the best. We trade this strategy, as said, with two contracts because this kind of market has not a very high volatility, and for this kind of reason it is also scalable in a certain sense. This strategy, as said, is a trend following one, so it enters long when a break above the high of the current session happens, and vice versa for the short side. We will enter short when we break below the low of the current session. We can see that the equity curve was really good during the last years, with we can say a very flat period, and in the recent months we can see the strategy started performing well during end of March, starting April, and from that moment it continued to rally really good, and so we are happy to see again this market performing as we expect. We can move now to the next strategy, that is again a trend following one, but this time the strategy was developed on the soybean future, and also this strategy is a trend following one, and it enters long when a break above the high of the current session happens, and vice versa as the previous strategy for the short side. We can see that the last trades were pretty fine. We see both stop losses and take profits. We can see that now the strategy is long with one contract in profit. Here we can see a stop loss, then a profit target, and as said, an alternation of good trades and bad trades. Overall, as said, we can see the equity curve detailed of the strategy, and we can see that initially the last year was pretty bad. We can see here the drawdown, and then from the last months of 2020 the strategy started recovering, reaching its new equity peaks. We can see it also here with the equity curve close to close. Let's have a look also at the list of trades. We can see a small loss for over $300, and then a profit of around 1400. As always, these results are already including commissions, costs and slippage, and so we can consider these results as clean results.
Hi everyone, and welcome back from Andrea Unger. Today we will continue our analysis on the US stocks, and in particular we will try again to apply the strategy we have seen in the previous episode, but this time today we will analyze two different baskets, and in particular we will see the same strategy applied on the Russell 2000 index components and on the Dow Jones Industrial Average components. I remember you guys, this test is made considering also the survivorship bias effect, and for this reason, to be able to do the test on the root index components, so on the Russell 2000 components, 8,942 files containing the data of the components that had been or has been into the index composition have been analyzed, and then only after verifying which one would have been used into the strategy, 5,193 of them have been wiped out. So a huge amount of data is considered to perform this test since January 1st, 1995 up to date. So let's start with the Russell 2000, and for this test I tried again to buy the worst shares on an amount of period of 6 months initially and then 1 month later. and the rebalance frequency is always, as usual, every end of month. And because of the index composition was significantly higher if compared to the S&P 500 and the Nasdaq 100, I decided to consider 25 shares stocks instead of just 10 like the previous time. And for what regards instead the Dow Jones Industrial Average Index, I decided to consider 5 stocks, because of course the composition of the Dow Jones Industrial Average is made only on 30 stocks. Okay, so let's start with the Russell 2000 at 6 months, and here we have the equity curve. As you can see here, the equity of the portfolio would have completely destroyed the portfolio in this case, and in fact here you would have lost all the money, most probably. And we have also to consider that the drawdown of the portfolio is significantly higher than the drawdown of the benchmark. So you would have done significantly better just buying the ETF on the root index, if compared, of course, to the result of this strategy. Now let's go to the Russell with 1 month period analysis. And here the results are pretty strange. In general, I see there is no particular advantage in buying this selection of stocks, but it's curious that in the last part of the equity, the portfolio would have achieved quite good results. But this phenomenon seems to be related only after the pandemic effect reabsorption. And in fact, if we go into the yearly gains chart, so here we can compare the gains of the portfolio to the gains we would achieve just by buying the ETF, we can see that in very few years, the strategy would have made better than just buying the ETF. And now let's move on to the Dow Jones, and here we have the equity curve. Also, this case is pretty curious because in the first part it seems the strategy had performed well, but with the falls of the stocks due to the world economic crisis in 2008, you would have lost all the gains achieved previously. And then after, it seems there isn't a particular advantage in choosing the worst 5 stocks from this basket. And now let's go to the last example of today. And here we have another curious example. And here we have considered the worst stocks of the previous month. So instead of the 6 month, here we have just the very latest month considered. And here it seems there is an advantage since 2009, so since 2009, but I think I wouldn't trade anyway this kind of strategy because it seems an isolated case. So I would be pretty worried about this kind of strategy in general.
Rollover calendar. Next week we have the expiration of crude oil future, but we have already rolled it. And as usual, all the other energy futures will follow. Next week we also have the VIX future settlement date. And finally, I remind you that as regards metals, we are approaching the first notice day, which is at the end of the month. I hope you enjoyed this video, and if you want to learn more about the trading method we at the Unger Academy use and teach our students, not to miss out on reading Andrea Unger's new book. It's called The Unger Method, the winning strategy of the 4-time world trading champion. And in it, Andrea explains step by step the trading method that let him win 4 World Cup trading championships, and that you too can use to improve your approach to the markets and achieve your trading goals. And the greatest thing is that now you can grab it for free by just paying for shipping and handling. In the book there is also a rich bonus area with links to videos reserved only for those who get the book. Don't miss the chance to take your trading to the next level. Click the link in this video and get your free copy of the Unger method now. You pay only shipping and handling.